Today I'll be looking at why having over $1 million saved does not automatically give you the retirement spending freedom that you might expect. Over my many years of working with retirees, I found that many people struggle to actually use their savings despite hitting this impressive milestone of having over $1 million. And that's exactly why I'm making this video for you today, to show you why seemingly substantial retirement savings does not often translate to the lifestyle that many people anticipate in retirement. Let's get right into it. But before I get into the details of why you may need more than $1 million, let me give you an example of a client that I had. I want to share with you Joe and Jennifer's story. Obviously, their names have been changed to protect their identity. But Joe and Jennifer, they were 60 and 61 when they came to us, and they had over $1 million spread across different retirement accounts that they built up throughout decades of retirement discipline savings. They had finally reached that $1 million milestone that they worked so hard for their entire career, and they really expected to feel confident about their retirement finances, but they found themselves paralyzed when it came to actually spending their hard-earned savings. Despite using retirement calculators and reading financial articles, they couldn't determine a safe withdrawal strategy, and they worried that their spending decisions might jeopardize their long-term security. They were really unsure of how much they could spend with the savings that they had. And then they thought about, when do we take it out? How much taxes do we pay on that? They had a ton of questions, and because of all these questions, they were still working. The major problem that they are facing is that even though they have successfully accumulated over $1 million for retirement, they just can't figure out how to actually use this money to support their retirement lifestyle. They are stuck in a perpetual mindset of savings and not thinking about spending the assets that they have. They didn't have a clear strategy for turning their savings into income. And remember, retirement is about income. It's not about a specific magic number like $1 million. And if you feel like you're in a similar situation to these clients that I'm talking about right now, that if you don't know if you're saving enough, click the first link in the description below where you can fill out a few questions. And after you do that, I'll send you a complimentary video giving you actionable advice that you can implement right away. This problem of not knowing how to spend their money safely was having a negative impact on their lifestyle and on their retirement planning every single day. It was causing a lot of fear and anxiety for them. They continued living far more frugally than they could have because they were unable to enjoy the wealth that they worked so hard to build, because they were scared. What should have been a time of financial confidence has instead become a period of increased anxiety about spending decisions that they're currently making. They found themselves hoarding their retirement savings, unable to use it how they intended to use it. They were sacrificing their quality of life despite having accumulated significant wealth over their many years. Before they met us, they really had no plan for their retirement, no plan to transition from work to retirement, and they had no income plan either. And I'm going to give you our solutions later on here in this video. Now that you've seen how this was impacting this client, this next piece that I'm going to share with you is specifically important because I'm going to cover exactly how to figure out why you cannot spend your savings based upon this exact client situations. There are several key questions that we ask our clients, and some of our most common answers to these questions I'm going to share with you right now. It's extremely important to ask these questions because as financial planners, it really helps us get to the root of the financial issue or problem that's holding you back from living your best life today and in retirement. I'm going to share with you 4 of these most common questions right now. The first question that we get a lot, that we ask our clients a lot is, what is your expected annual spending limits in retirement? And honestly, this one trips a lot of people up because they don't know how much money they're spending today, and they have no idea how much they're going to need to spend in retirement. They don't know their income need, they don't know their tax situation, they don't know how much money they need to have and how that money needs to be invested. We love to give clients paychecks in retirement just like they have during their working years. It gives them a stability and peace of mind knowing that I got another paycheck coming in 2 weeks. So it's key for us to know the money that's coming in next month in retirement because mentally it helps you make that big transition from working to not working. You have to pay attention also to how you're spending your money pre-retirement and how much you're spending pre-retirement so that we can properly plan for your future. The next question that we get is this: how is that $1 million retirement portfolio, just as an example, invested? And how are you planning to combat the sequence of returns risk? Now, when we ask clients this, we're really asking them, how much risk are you comfortable with? So you, as an individual investor or as a couple, How much risk are you comfortable taking on? If you're comfortable on taking more risk, then you're going to have more money in stocks. Less risk, less in stocks. And to do this, we do what we call an asset allocation questionnaire. This is just a simple form that you fill out, and it helps us calibrate how much risk you're comfortable with. It helps us figure out what your risk tolerance is. But it's very important that we actually use the findings from that fact finder to then invest your money in that matter. And also, it's very important that you get a plan for what you're going to do if the market were to drop and that you stick to it. Inside of our Red Zone retirement planning process, what we do is we get fixed incomes needs covered by fixed income sources like Social Security, pensions, and income annuities. And then what we do is we get variable investments to cover the variable expenses that you have. In addition to that, you have to have at least 12 months worth of cash on hand to use if the market were to drop, so that we're not selling at a low. And if you want to find more out about my Red Zone retirement planning process, just get a copy of my book. It's available on Amazon. To battle the sequence of returns risk that I mentioned earlier, we need to follow our Red Zone retirement plan investing process. Again, you can find this in my book. But how we do this, money that you spend right away in your first third of retirement is invested conservatively, and money that you spend later in your retirement is more aggressively invested. Because we don't want to risk assets today that we're going to be spending in the market. You don't want to take on excessive risk as an investor unless you have to. With a lot of our clients today, we're using guaranteed accounts because interest rates are relatively high compared to what we've seen in the last decade. The third question that we ask is this: what is your plan for handling large unexpected expenses? And what I'm talking about here is a few things: long-term care cost, medical cost, legal expenses, and are you going to help the kids and grandkids? Really, in this part of our conversation with clients, we really have to talk about how you're planning to pay for these things. Are you going to insure against it with long-term care insurance? Or are you simply going to avoid that risk and pay for it if it happens? We're big fans of avoiding long-term care risk altogether with insurance products because they're extremely affordable if we do them at a young age. And if you're going to absorb the risk and pay for it yourself, I would just encourage you to talk about it and understand this is a potential cost that you're going to have to pay in the future and have a plan for it. Don't just wait until these events happen. Plan for it and figure it out ahead of time. The last and final question that we ask is this: how does your retirement timeline align with your tax-efficient withdrawal strategy? Now, a lot of people don't know how to question this, and that's really where we come in, and this is what we specialize in. What we do is we look at your tax situation today, how you're saving, how you're investing, and then how it's going to look 20, 30, 40 years from now for you and for your beneficiaries when they inherit the money. We look at, do you have an RMD issue that's causing a massive tax bomb? Do you have IRMA tax issues that's going to cause you to pay a higher Medicare premium? In our process, the Red Zone retirement planning process, we map out the exact tax rates for you for 30 years plus, and we give you actionable advice to save you as much money today on taxes as possible, from Roth conversion strategies to qualified charitable distributions, and we help you save money on these taxes not only during your lifetime, but for your beneficiaries as well. These questions and answers should spur on some thoughts for you. And if you want a more detailed breakdown of the Red Zone retirement planning process, again, grab a copy of my book. It's on Amazon or it's on my website, adamolson.com. Now, I want to walk you through what our recommendations were for Joe and Jennifer and why we had to wait 18 months about for them to retire even though they had over $1 million. The first thing that we did is we got them to do a budget so that they could actually see how much they're spending now, and then that helped us figure out how much spending they were going to have in retirement. Next, we had to wait at least 18 months for them to build up enough cash reserves, and then we also had to wait for that first Social Security benefit to kick in. Also, it was good to give the investment some more time to grow. We showed these clients how strategically claiming their Social Security benefit would give them a guaranteed paycheck for life. Also, for these clients, we bulletproofed their retirement plan because we took $200,000 from an old retirement plan and we put it into an income annuity for them. Again, this was to cover the needs that they had. So we get fixed income sources to cover fixed income needs that clients have. Think food, shelter, clothing. Those things were covered between Social Security and the $200,000 from this old retirement plan. With these two tools, we were able to completely cover their fixed expenses. We then planned for their retirement. What we did is that we had 12 months worth of living expenses built up in cash, because if the market has a downturn, then we can access that cash without selling off investments. Next, It was time to bulletproof their plan. We did that already through the lifetime income, and we put in a great long-term care protection plan for them. In addition to that, what we did is we had to get some of their assets more conservative. So what we did is we sliced off $250,000 and we put it in a guaranteed account that they will plan to spend the first 8 years of their retirement. There was no market risk to this account whatsoever, and the clients were thrilled at the interest rate that they got. We also showed them how to implement a Roth conversion strategy from age 63 to 67 to lessen that RMD tax bomb that they were going to have in their early 70s. Also, we gave them a lifetime income, and we showed them how we were able to do that through our planning process. And what we do with our clients is we plan for index spending in retirement through 3 different phases: the go-go years, the slow-go years, and the no-go years. So what we do is we plan on spending more money early in retirement than we do later in retirement. So what we do is that we decrease spending for our clients in the second third and the third third of retirement, because you're not going to be as active. You're not going to be spending as much money on travel and leisure. What that does is that helps clients live their best retirement life early in retirement. This enabled them to live confidently, knowing that they had enough money for their entire life, and it allowed them to see the spending over their entire retirement as well, which was extremely important for them mentally to comprehend moving into that retirement phase. Now that you know why reaching the $1 million mark doesn't automatically mean you can start spending freely and retire today, you can develop a more realistic approach to your retirement withdrawal strategy. But if you're looking for more help, I've put together an entirely free retirement assessment that will help you give personalized insights about your retirement readiness. It walks you through the same process that I use with clients that I work in and day out. And at the end of it, you'll get a complimentary video from me walking you through what strategies that you need to implement to bulletproof your retirement plan. To take action, just click the link in the description below, and I look forward to seeing you in the next one. This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection lost against loss in a declining market. Purchase of life insurance is subject to meeting underwriting requirements. There is no guarantee of an individual will be insured. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax, and if taken prior to 59.5, a 10% federal penalty tax may apply. Guarantees are backed by the claims paying ability of the issuer and are subject to their terms and conditions.